Hello, everybody, and welcome back to EBNet Stream. We published an article recently from Private Client Holdings on time in the market. The thinking really is to remain invested in equities into your retirement rather than disinvest from the market as you approach retirement and consider your annuity options. I've invited Mark Macsymon, a wealth manager and CFP, and indeed a previous winner of the FPI's Financial Planner of the Year award, to join me this morning to explore this topic in more detail. Mark joins me from Private Client Holdings, and I should mention that all our conversation today is not considered financial advice. Welcome to EBNet Stream, Mark.
Hi, Natalie. Thank you for having me.
You're welcome. Let's get straight into it. The way I understand your warning of avoid de-risking too early is, very simply, don't disinvest or switch out of equities just before you retire, when really you're going to switch back into them in your living annuity. Is my understanding correct?
Yes, that's exactly correct. And I think critically, do not disinvest in equities early on in your retirement. So the industry has generally divided an individual's retirement story into, let's call it, pre-retirement and post-retirement, the wealth creation phase versus the wealth preservation phase. And generally, in the wealth creation phase, individuals are seen as more risk-taking, have a higher appetite for risk, have a long time horizon, in comparison to the wealth preservation phase, where they have less appetite for risk, have a much shorter time horizon. But the argument here is that we want to see the retirement journey as a whole journey, not a separate pre-retirement versus a post-retirement story. So we looked at some numbers and a scenario where an individual saves for retirement up until the age of 65, starts saving in their 20s, accumulates an amount of capital, and generates a return of CPI plus 5% after costs. So that's typical of what a high equity Reg 28 portfolio is likely to give you over the performance of time. And then that individual retires on an after-tax salary of roughly 75% of their final income. And generally that's accepted to be a scenario where individuals are able to retain their standard of living going into retirement. And so for 30 years, that individual can lean on that retirement pot, retaining their standard of living, draw down on those assets over time, so long as they remain invested in a fund that is able to deliver CPI plus 5%. And so the theory is that you accept or you experience the same level of risk and return before retirement as you do after retirement. But here's the kicker, right? At retirement or during that retirement phase, that wealth preservation phase, individuals generate 87% of their overall returns in that phase. Now, I want you to picture that, right?
Wow.
87% of returns are generated during retirement, so long as you persist with that same strategy. If we get conservative in retirement, right? We retire and we pursue a strategy that is significantly lower in the driver of growth, significantly lower in equities, both local and offshore, and pursue a strategy of CPI plus 2%, or that is likely to deliver CPI plus 2%, preserves our capital, provides stability, higher incomes, and we generate that CPI plus 2%, that individual will retire and run out of capital 11 years sooner, most likely in their late 70s, than they would had they not persisted with that CPI plus 5 strategy. So the idea is to remain invested. That's the key message. If you are moving in that living annuity route, and I guess that's the caveat, if you're moving in that living annuity direction, the key is to remain invested and not to reduce risk to enjoy, I guess, a smoother ride.
I was sorry for interrupting you there. I was about to say, so is it dependent on a living annuity versus a different kind of annuity selection? But you kind of hit that with the clarification. We're talking living annuities. But just to kind of maybe explore that a little bit more, if I were to purchase a with profit annuity, are we having the same conversation?
I think potentially yes, but let's think about this.
Mm.
To make the correct decision about how much equity to have in one's portfolio in the build-up to retirement annuity, one needs to have a strategy generally as to whether or not you are likely to transfer your benefits to a living annuity or to a life annuity or to a with profit annuity. And I think many retirees or potential retirees don't necessarily have those insights. One's pension fund is very often not the only asset that one has. Many people have preservation funds, they have other discretionary assets, they have other sources of income. And in order to make an appropriate tax mindful decision for someone, you need to take all of those considerations into account. So it could be the case that in the build up to retirement, and the balance of probability is that an individual continues or at least transfers that benefit to a living annuity. It's important to remain invested, but if the likelihood is that a life annuity is more appropriate or a with profit annuity is more appropriate, well then a different set of decision making protocols is required in advance of retirement.
Sure, I understand that. To play the thinking out then around the living annuity, many retirement funds offer members a life stage investment strategy. And really the basis of that is the equity exposure is down weighted as the member approaches retirement. The logic behind it really being to protect the member, obviously, from drastic market drops right before they retire. Having now thought about kind of the argument about staying invested, if you're thinking of purchasing a living annuity or considering a living annuity, what are your thoughts around, let's call it the traditional life stage investment portfolios that a board of trustees would put in place?
So the reality is it's going to work for some and it's not going to work for others. Okay, that's important. It's going to work for some, but it's not going to work for others. So the default life stage model that reduces equity in the build up to retirement is appropriate on the balance of probability if the individual is likely to transfer that benefit to a with profit annuity or a life annuity. Right, then we're wanting to preserve as much of that retirement benefit, provide certainty, ensure that there isn't a surprise on the downside with respect to their expectations of what they're likely to earn from their retirement. But, and I think flowing from this conversation, is that if it is the case that the annuitant, the retiree, is more than likely going to transfer that benefit to a living annuity, then you don't want that to take place. In fact, the worst case scenario is if you have those life stage models and there's a reduction in equities and markets continue to move upwards. And what do they say about markets? They move up with the escalator and down with the elevator. If they miss, let's call it a bull market, an upswing in markets, and do not participate in growth in the 5 to 7 years leading up to their retirement, and they plan to transfer that benefit to a living annuity, and then all of a sudden invest in that living annuity, and we have poor market performance in that first year of retirement, that is a disaster scenario. That is a disaster scenario. So, and I think I raised the point earlier, really what you want is a scenario where retirees or annuitants or pension fund members have a degree of foresight as to what is the appropriate solution for them in advance of retiring. That's really where you want to be. If you have that foresight, if you've gone through various cash flow analyses, or for want of a better word, a financial needs analysis, and you have certainty about what you're likely to do with your retirement funds, you can then make informed decisions about whether a life stage model is appropriate for you or not. But in the absence of that, you can't make that decision. And that boils down to the correct advice.
It leads me in such a lovely way into my next question, which is really around the value of advice. Sorry, the value of advice, and how a structured investment strategy can really give stability and growth for long-term financial success. And I wonder if you maybe want to talk a little bit around that. We understand that trustees of retirement funds are doing the best they can with what they have, and it to some extent is a one-size-fits-all in a group scenario. But what in your opinion should members be doing outside of their pension funds or provident funds when it comes to, let's call it, deliberate structuring?
So I would agree with you. And one of the points you raised there is that, trustees certainly are doing their best. And we know that individuals are very poor at making long-term decisions for themselves with respect to retirement planning. I mean, let's call it hyperbolic discounting. And we know that Nobel laureates Richard Taylor and Daniel Kahneman have written extensively about this. And so default decisions are imperative for individuals making contributions or making an effort to save for retirement. But what is the best case scenario? And the best case scenario is a formal structure whereby life is breathed into the purpose of an individual's wealth or financial plan. And so we follow a process at Private Client Holdings called goals-based wealth management. And what that process is all about is it's trying to understand the various goals and objectives or needs of an individual or a family. And so we typically want to understand what their lifestyle objectives are, what their legacy or succession objectives are, potentially other asset acquisition activities. And then instead of purely relying on a risk profile questionnaire or an attitude towards risk, really what we're doing is we are optimizing an investment strategy to improve the probability of success in reaching all those goals. And so that's, in a nutshell, the scientific way of ensuring that we don't use you referred to it earlier, a one-size-fits-all type of structure for individuals. This is a carefully curated, personalized approach to managing an individual or family's wealth, breaking down their various goals across time horizons, setting risk and return parameters or strategies to optimize the likelihood of achieving those objectives. So that's what goals-based wealth management specifically refers to. And essentially, as I mentioned, their optimal asset allocation is ultimately revealed through their various goals. Now, we've got obviously sophisticated software that helps us track progress and the probability of success towards achieving those various goals. But what that process does is it keeps clients engaged. It keeps clients invested because, you might ask me, what could go wrong, right? Markets generally go wrong from time to time. Markets go through their boom and bust phases and cycles, and very often we feel very happy and comfortable and excited about our investments. And then there are other times when investors feel fairly depressed, bleak, and despondent about their investments. And it's very often at those times that we need to stick to those strategies. And in the absence of having a wealth management strategy, the likelihood is high that people want to change strategies. And very often it's at that exact time where it's the wrong time to make adjustments, to lock in long-term losses, to switch strategies into something potentially more conservative, as we spoke about earlier. One needs to remain invested. And I think that's the real benefit of having a strategy or a rational sounding board as an advisor to help you migrate these times when decision making can be difficult.
I'm so glad you talked about the feeling one has that I must do something, rather than really kind of just sit and leave it, which is not financial advice, but probably the best financial advice, because it kind of segues us into two parts, and I don't want to have a big conversation around two parts, but the reality is it was a big deal in our industry over this year, and now we sit with a scenario where we have members of funds that have two disparate possible goals. One is the short-term emergency fund, for want of a better word, in their savings pot, and one is the retirement pot, which is now compulsory to preserve. So really this kind of sentiment of building assets for retirement. This disparate kind of need for these two pots, or that these two pots represent, does that factor into an individual's investment strategy that you're talking about?
And it does, and it's a good question because we haven't experienced it yet. But let's, in thinking about how we can make appropriate decisions for and in behalf of pension fund members, is to take a polar case, for example. Now, there are certain types of pension fund members who are not going to use that savings pot during their lifetimes, because in the ideal sense of the word, they have those monies available to them in a discretionary account, available to them in a money market fund, and so that when they need that emergency pot, they have it available to them. Now, not everybody has that luxury, and when we think about the two-pot experience more recently and the volume of outflows from retirement funds, the volume is staggering, and it just shows us that people don't have those excess monies available, and generally they're living above their means. And so let's swing to the other side of the fence. There are those individuals out there who will be perennial withdrawers on an annual basis. Their contributions will be split 2/3 into the retirement pot and a third into the savings pot, and on an annual basis, they're going to be withdrawing those monies, really kicking the retirement can down the road. Now, your question is, how are those monies supposed to, or how should those monies be invested? And I think overall, what we may see is a slightly more conservative stance on potentially the way in which those savings pot monies are invested. And theoretically, those savings pot monies should be invested more conservatively, with potentially a high allocation towards bond and cash, call it flexible fixed income funds. But once again, it's hard to make these decisions in isolation, because to be able to make an informed decision, once again, a pension fund member needs to have help, or needs to have some sort of advice as to how to invest those monies. I just don't see how individuals will make informed decisions about how to invest those monies in the absence of some sort of advisor. And it's quite interesting having this conversation, where it's hard for me to envisage how people make, or how retirees or pension fund members make sensible decisions over time without having advice. There's so many junctures along someone's journey where they desperately need that advice, and potentially that advice is not available.
I'm so chuffed you mentioned that point, because and it's no disrespect to you and the valuable work that advisors do, but in all honesty, from my side, and if I have this thought, I'm probably not the only human in the world to have it. I've always had this impression that consulting a wealth manager or a financial planner is only for people who are already well off. And so I may feel a little bit intimidated, or I may feel that I simply don't have enough that would be of interest to someone like yourself, or a certified financial planner in general. What would your advice be to people who share my thoughts and sentiments?
Well, I think you hit the nail on the head, and there's no doubt that South Africa in general has an issue with what we call the advice gap. And there are more people in South Africa that require expert financial guidance and advice than there are people with which to provide that expert advice. But there are almost, I think, either a touch more or a touch less than 6,000 CFP professionals in South Africa. These are individuals who have written the CFP board exam. They have the relevant years worth of experience. They have the right credentials in the sense of meeting the requirements for the CFP designation in terms of NQF level qualifications, and they subscribe to the FPI's code of ethics. So these are the right people that individuals want to be dealing with. Now, one of the common denominators I think about these people is they generally want to help. Financial advisors, and I'm going to generalize here, but CFP professionals, in my view, and of the many that I know in our profession, are generally quite caring and empathetic people. So if I was one of those individuals who knew with certainty that I needed financial guidance and expert financial help, I would go on to findinadvisor.co.za. I would look for a CFP professional that is close to where I live, and I would present myself and say, listen, I really, really need help, and I might not have the assets to pay the fees that that would warrant your time, but I'm sure there's another way in which we can arrange a fee arrangement that can be suitable for both parties. And in the first instance, it could be pro bono. In the second instance, it could be some sort of a retainer. And then as time goes on, there could be some arrangement where fees are deducted from assets under management, which is typical for our industry. But my sense is that for those individuals who are committed and deliberate about wanting to make the right decisions about their financial arrangement, there are advisors who are very willing to help and act as that rational sounding board, that advisor for making clear decision making when, from time to time.
Thank you. To wrap up then, the two-part legislation has really forced the previous disparate worlds of institutional and retail consulting to work together. And thank you, Mark, for sharing today this very, very important conversation. And I believe it's the start of more important conversations as we explore the implications of the changes in legislations and the kind of nuances of markets and how these two advisors or advice models need to get closer together. So thank you. Hopefully we can chat again soon.
Absolutely. I look forward to that. Thanks for having me.